Silver's way more important than we know. Silver's too important to let the price be left in the hands of the plebs. It's a critical metal. They don't talk about it until they're done buying it. Right now, they're buying a lot of it.
Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. We're back with part 2 with Vince Lanci, managing partner at Echo Bay and publisher of the Goldfix Report, adjunct professor in finance and commodities, and the host of the SilverFix at Arcadia Economics. So, Vince, I want to welcome you back and continue our conversation.
Yeah, let's go. I'm excited.
You know, Vince, in the prior episode, we were talking about the price of silver, price of gold, and how there is a difference. We're seeing that difference between the East and the West. And the way we measure the price, of course, you know, it changes every second or so, the spot price, that is. But with the BRICS nations who are looking to have, you know, silver or gold, whatever it is, to sort of back their currency in some ways, is what people are saying. They are looking at using a type of a moving average instead of a second to second spot price to price the commodities of silver and gold.
You know, yeah, that was one of the things that I saw that made me realize they were serious. You know, if the West, we dominate the financials, among other things, but we dominate the financials. And if there's a price or a time of day that your books are marked to, you get margin calls, you know, as individual investors, or and the day-to-day volatility, if you look at statistically, the day-to-day volatility of gold and silver is very high. The decade to decade is not. Now, silver is still high, but that's because it's just it's just too cooked as a market. But for these guys, they're looking at silver. They're definitely, silver's going to be part of this equation. But just to focus on gold because it's easier to see, the price of gold over 20 years. You know, what is it? An ounce of gold buys you a fine suit, you know, 100 years ago or last week, or, you know, whatever. An ounce of gold is, and to the extent that there are shenanigans, whether intentional or accidental, in the gold market, the volatility of price can really punish someone who has to make what they would call an irrational sale. Turkey would be an example of that. So if you're a country, and for whatever reason you need dollars, for whatever reason, you're buying, I don't know, you're buying Apple iPhones, right? And so you have gold. And you're like, I'm a little bit short on dollars right now. So you go and you sell a little bit of gold. Well, it's such a small community. The BIS, the IMF, they're at the center of this, and traders run those desks. And if I see that you're selling, and I know that you're not that sophisticated, and you're a bureaucrat who might be a little bit sloppy about it, I'm going to profit from that. There are many ways to profit from that. But ultimately, the short-term price will move worse. And I will be, as a person who needs, as a country who needs to sell. It's a panic for iPhones. I need to get them. I'm hitting the bid, and the price that I'm selling at is going to be potentially substantially lower than the average price for the last 6 months. So one of the things the BRICS are doing right, execution is important. We can talk about that another time, but one of the things they're doing right is they're saying, we're not looking at day-to-day price for transactions. We're looking at a moving average. So if they get the technology right, what they want to do is they want their regional trade to be not in dollars, right? Why do I need dollars? You're buying oil from me. I'm buying wheat from you. We're neighbors. Let's use something else. So they settle. They use what's called a current account settlement. So it's I buy $1 billion in oil from you. You buy a half $1 billion in wheat from me. And at the end of the day, there's a difference. At the end of the day, the difference is $500 million. Well, how do we deal with that? There's no credit now. There's no credit in this environment, or, for the moment. We settle it in gold, and you're going to settle it in silver as well. Maybe you do some sovereign bonds, but you're settling in precious metal. But the price of the precious metal, because of the West uh, management, we'll just call it management of expectations. The price goes like this. Meanwhile, the bond price is like that. But gold is a AAA asset. Gold and silver are the only assets that don't have counterparties. So how could they be like this and a piece of paper be like that? And so the BRICS are saying that's not right. So instead of us settling, so I buy the oil from you, you buy the wheat from me. It's a $500 million difference. What's the price of gold? You, you can't do that and, and inspire confidence, because if I'm a big country and you're a small country, then it might be to my advantage to become adversarial with you and force you to sell me the gold cheaper if I become a predator. And the way you do that is you create a moving average. And it's not a new concept. I love it because in the tens, the US was trying to create ETFs for commodities, oil specifically. And the oil ETF commodities, they have a big problem. The big problem is, the rollover. You see that with silver as well. Um, and so they figured out the way to reduce the rollover volatility was to move the ETF price to be a weighted average of the first 6 months, which is what the BRICS are doing. So we're no longer looking at this price; we're looking at a smoother price. And so in doing that, you're not only making the weaker cousin in the transaction comfortable because they can't really distort the price. You can't distort it for 5 minutes and hurt me. You can distort it for 5 months and hurt me. That's different. But you're also showing that this asset is way more stable for trade and we trust each other a lot more than normal. And so you are effectively neutralizing any short term tactical manipulations. It's great, smart.
If you're enjoying this interview with Vince Lanci and I, please consider subscribing to our YouTube channel. And if you have been thinking about opening up a precious metals IRA or wanting to understand a bit more about it, please visit our website, www.silverbullion.com.sg, look for the IRA tab, and view the 3 simple steps to get you started. Yeah, so I guess with that method of using that moving average, you will to basically take away all of this things like spoofing and these things which tend to move the market and tends to hurt a lot of people along the way. But one question here: if we go to this type of a moving average, uh, are we going to see the, let's say, the Jim Rickards $30,000-$50,000 an ounce gold type of thing coming into play or happening anymore?
No, you're not. You're not. I mean, you could see it in the West. It depends on uh, if the exchange is really split, meaning the COMEX and the Shanghai. Let's say there's other Dubai is important as well. If those exchanges really split, then you could see a huge price difference in terms of dollars versus yuan. But I think to answer your question just simply and directly, um, the moving average, at least for our purposes, the moving average is not going to be the price we see on the screen. The moving average is what they'll be using to settle trades behind the screen. So you'll still have day to day price. You'll still have a price that goes up $10,000. It could, but like this, this certainly removes day to day volatility to the extent that they do this model. But it doesn't affect long term price. It really doesn't. What it does is it allows us to do big trades. It's like a block trade. We do big trades without worrying about affecting the price. That's really the idea. No, but it should have zero effect on that phenomena of where gold can go and stuff like that. No, it'll be fine.
That's a great point there because let me try and unpack a few things here because I mean as mentioned, there is a difference in the price of gold when we look at the West and the East and how it's being priced. And you're mentioning strong hands, and of course China is definitely the one with the strong hand here. I mean, almost everything is either mined or refined in China. So much of what the world needs comes from there.
That's
And
right.
to speak a bit of their cohort of and trust, Vladimir Putin said something along the lines of, "Once this de-dollarization starts, there is no turning back." I mean, what's your
Right.
opinion on the return, if there's going to be a return, to the trust, as you mentioned, the trust and strength of the U.S. dollar?
Oh, that's actually very tactical. I'll start by saying I don't know, but I think one of these type of things is going to happen. Um, if let's pretend overnight everyone else becomes like the BRICS, and they say we don't want dollars anymore, right? Well, if that were to happen, other than the fact that the world would end financially, it really would. Um, the U.S. would have to. Your question is, how do they win the trust back? And the answer is, um, well, there's one of two ways. If they want to stay on a purely fiat uh, economy because of their ideology, or because they're stubborn, or because they, uh, well, there's legitimate reasons to use fiat. Um, for whatever the reason, if they were to do that, they would need to, if the U.S. doesn't go on a gold standard, it needs to get highly productive and fiscally responsible again. The problem is those two things aren't going to happen at the same time. We need to become fiscally responsible, stop spending. That'll make people trust the dollar. We also need to um, evolve to the next manufacturing generation. And now we're spending money on that. So you're spending money on retooling your economy, right? At the same time, you spend too much money going into this situation. So if the U.S. were to get its fiscal and economic house in order, that would go a long way to satisfying many nations. But there's one thing that won't satisfy them. It's not just the U.S. economy and the U.S. way it handles business domestically that's concerning the BRICS. This all started because the BRICS, and not just the BRICS, most countries know. They didn't really understand, but now they know. Now they really understand it. That because the dollar is the global reserve currency and treasures the global reserve asset, that the BRICS part of their contribution to the economy, the world economy, natural resources and labor, was undervalued, was repressed, right? Because of the magic that we do with the dollar. Yes, we have the best military. Yes, we kept the peace. But at what price? And we're not even keeping the peace anymore. So there's an abuse, there's an abuse that they perceive, right or wrongly, about our handling of our status. So even if domestically in the US we would all be, oh, we got our economic house in order, the BRICS ain't coming back. They're not coming back because they know that we manipulate their currencies lower. I kind of look at it like this: the dollar won't come back as a global reserve currency fully ever. And we're not even at the point where it's lost some of it. You're going to have two monies in the world. You're going to have Western money and Eastern money, to simplify it. Western money will be fiat and technologically based, meaning uh, productivity, very, very, very man overcoming odds, that type of stuff. Post Renaissance stuff. We'll solve the problem, whatever, with technology. And then in the East, you're going to have uh, uh, less of that. So you're going to have a gold. So you have gold there, right? And you're going to have paper money here. And let's pretend that the world's stayed that way. Well, you're going to have deflation over there in the BRICS, and you're going to have inflation over here. And what'll happen is it'll go away when we start doing trade with them. They need to buy our guns, our whatever, our iPhones. They don't, but let's pretend that they did. If they need to buy our iPhones, then they need dollars, but they have gold, and so they're going to have to convert gold to dollars and do all that. Us, if we need to buy oil, we're going to have to convert dollars to gold. So I don't know if I'm answering your question directly, but what ends up happening is the dollar can't. This isn't going to happen. The dollar's not going to go back to 100% reserve currency. This is Not changing. This is uh, an aircraft carrier that's turning in the water. It's not going back. If you push this aircraft carrier back, you're going to have it turn over. It's done. Globalization is done. We're entering into a deglobalized, mercantilist, Cold War II environment where the trust won't come back. That's your question. It's about the trust. The trust doesn't come back until we earn it. And we're not going to earn it because everyone knows that if you leave someone in charge too long, they abuse it. And so now we need a more decentralized form of trust. And that's what the BRICS are trying to do. How successful they'll be, I don't know. But no, the dollar is done. The dollar is done as the only world reserve currency. That's the whole point of multipolarity.
Right. That's a good way to explain it. But Vince, you also touched on inflation and with all the hotspots in the world affecting food prices, technology, oil. Do you expect these things to begin sort of a inflation creep where people perhaps all over the world, as mentioned, start to sense that they are no longer able to afford expenses due to the current cost of living?
Standard of living all over the world will drop. That's my one sentence answer. And uh, the U.S. will probably have the biggest drop, but we're so high up we won't feel it as much. It's like we won't be able to buy the third color TV, the third flat screen TV. Meanwhile, this country over here loses 10% of its ability to buy. People starve. So I think first of all, inflation beyond the event that we have now, the event that we had that came out of the the excessive fiscal stimulus, the airplane money or helicopter money, that's going to happen again. But let's pretend that it doesn't. Um, we can't put the genie back in the bottle here. Between Volcker's end and Pal's beginning, that whole era was dominated by the perfection of globalism. Uh, we triumphed over the USSR. Volcker raised rates so aggressively that he just killed inflation and everything else, right? And the whole world suffered. And but as the inflation went away, it created like a tailwind of disinflation. So the Fed could do no wrong. They lower rates, and inflation just kept going away because robots, logistical supply chains. Walmart became great at getting. And China was our lender. The China lent us money. But when the supply chains break and the trust is gone, you can't uh, do that anymore. And so as a result, well, as a result, everything you have goes down in price, everything you need goes up in price. So they're not going to be able to get flat screen TVs over in the Congo, right? Okay, well, that's not what they need. They need food. We're not going to be able to. We're going to pay more for our eggs, that type of thing. But the whole world standard of living is going to drop as a result of that. Yes.
I want to get back to some things we touched on in part one. I want to get back to silver. With the insights that you have, the info that you have, I mean, kind of a basic question here, but what is the future of silver? I mean, will it become loved again? Will it be a store of value? Well, that actually still is, but will it be, as some say, the general or generational investment of our lifetime?
Let me start off by saying that whenever you hear people talk about uh, industrial and green metals, they always talk about copper and they don't talk about silver. And, I see a lot of research reports and they rarely mention silver. And silver was the first thing I traded. I'm a silver person, so it's not like it's a hobby of mine. As I mentioned, I've taken delivery to see how it worked. Um, through the whole era of QE, which is the last 15 years, silver outperformed copper, it outperformed oil, it outperformed every commodity during the QE era. The only commodity that outperformed silver during that era was gold. That's because silver is very volatile. But the point is, they don't talk about silver. And this is coming from me. Silver is way more important than we know. It's a critical metal. They don't talk about it until they're done buying it. Right now, they're buying a lot of it. Now, to answer your question directly, without uh, making stuff up, silver's too important to let its price get out of control. They saw what happened under the Hunt brothers. They saw what happened last year or 2 years ago. They were panicking last year. Silver got above $30. They were freaking out. That was that the CFTC was panicking. Silver is too important to let the price be left in the hands of the plebs. That's a cynical statement, but that's how it works. Um, will it go up? Will it become an attractive investment? Yeah, it will. Everyone's going to say that on your show, right? But to be fair, the price of silver will go up when they're done buying, and they won't be done buying for a couple of years. That's my feeling about it. The other thing that makes silver go up in an easier way to understand, oh, they're monetizing gold, they're not monetizing silver. That's bad for silver. No, no. I wrote an article in 2016 when I was learning about China's uh, market structure. And it became obvious to me that when any country confiscates gold or uses gold or takes it off the market, silver becomes worth more. It has to, because it becomes money. I'm not silver is money for many different reasons, but silver is not a reliable money because um, it's actually used. If it weren't used, it would be money, but they have a use for it. The thing that makes silver money in a gold sense is the price has to go up to $1,000, and it can do that, not tomorrow. But to answer your question, over the last 15 years during QE, silver and gold outperformed every commodity on earth. Everything. Everything. Only stocks outperformed silver and gold for the last 15 years, which is the QE era. We're now entering a QT era, which is the era where we're going to have to keep raising rates to offset all the spending we're doing to fix our economies. And what you're going to see is you're going to see silver and gold uh, constantly creep up because they have to let the price go higher. The US is going to have to do something about its currency, and it will tie it to gold indirectly somehow, at least in private trade. And that means the price has to float higher. To answer your question about myself personally, uh, the last time I bought physical silver was last year, right around the time the Indians were buying it. Coincidence? I didn't know. Um, I'm in the market again to buy physical this year between now and November 17th, November 24th, actually. So I'm going to be a buyer of physical between now and then. And why? And this is how I'm running my money, right? Every year between August and November, there's a low, and every year I put a piece of my money into it, and I'm not worried about it. So I'm not looking for a home run from silver. I'm looking for a preservation of capital. We're going to get a home run, but I'm not banking on that. I'm banking on it to be real money. Look, the silver I have and the gold that I have, the coins, they're going to be gifts to my children when they go to college. That's you're going to be paying for your books with these coins, that type of stuff. So I wouldn't, I don't put my money in silver looking for the home run, but I'll take it when it comes.
Yeah, it's a great point there. Um, well, another question I have here is because you mentioned the price may not move all that much until they're done buying the silver.
Oh yeah,
So
yeah.
my question is, so we may not see these price gains all that much, let's just say, during this time until they are done. But when they're done, are you and I going to be able to go down to our bullion shop and pick up some silver? And I mean, even if we can, let's just say, I'd imagine it's going to be a far higher price when that comes.
All right. Uh, I think the way I said that sounded almost counterintuitive. So let me just restate that. For me to say the price will go up when they're done buying, just incredibly sounds incredibly counterintuitive. And in a free market, it is counterintuitive. The price goes up because people are buying, Vince. It doesn't go up after they're done buying. And I'm like, yes, but the price on the exchange is not the price they're doing deals. So the price is, if China, let's pretend that China and the US are mortal enemies. They're not yet. We're not yet, but who knows what happens. As long as the price is down at $22 and we're both buying and we're both going into that basket in the recess yard, right? Because everyone's breaking up and we're both taking balls out, as long as we're not taking each other's balls, we're okay. So the big powers are using low prices to accumulate. When they're done buying, they won't repress the price anymore. The price is repressed. I don't mean that in a conspiratorial way. It just is. That's the way the market structure is. A better way to explain that would be housing. Most people understand housing. Um, you live in a neighborhood, you have a house. Your house is worth $500,000. Down the block, they just raised the land and they're gonna put a whole new development there, and they're gonna be $1 million houses. Okay? The rule of thumb is, and this is true, your house doesn't go up in value because they tore those houses down. Your house doesn't go up in value because the $1 million houses are going up. Your house doesn't go up in value when the $1 million houses are built. Your house goes up in value when the $1 million houses are sold. That's how it works. When a developer moves into your neighborhood, your house doesn't go up until every new house is sold. Then it's like, let me take Patrick's house. Right now, your $500,000 house is now worth 750 because the $1 million houses are gone. The, right now, silver is at a low price. When there's no more left, right now they're finding it. The scrap places, they're taking everyone's offload. I mean, look, just to digress for a second, China is not just buying pure silver anymore. They're buying unrefined ore from Mexico. Mexican silver producers, I'm getting emotional here. Mexican silver producers are no longer just selling refined silver to China. They're selling unrefined silver because China just wants it. They just want it. We'll take care of it. Supply chain is over there, as you mentioned before, right? So when you tie all this together, there's less silver available above ground. When that silver is gone, that's the $1 million house is sold. Now you're my $500,000 house. That's when they'll let the exchange price go up. The exchange price, it sounds conspiratorial. I'm not accusing anyone of doing this. It's just the way the market is. The price doesn't go up until the big boys are done buying. And who are the big boys buying from? The big boys are buying from everyone who needs the money badly enough to sell. Just like when a BRICS country has to sell so they can pay their bills. That's it. So that's why I say counterintuitively, the price will go up when they're done buying. The price will go up more correctly when there's no more silver outside of the vaults to be had. That's what's going on. That's what I believe.
Yeah, my gut feeling for a while, a long time, has been, we're going to see, if not for nationalization of mines, you're definitely
Oh,
going to see state actors coming in, buying up forward supply from the mines, and I guess, as you said, um, creating that $1 million home type of a thing.
do, you know, your the comments, state actors, absolutely. As the world fragments, and I'm a country that knows that my natural resource is worth something, well, I'm kicking you out unless you pay me more. To your point about nationalization, if I'm a communist country or a socialist country, I'm just going to nationalize. Sorry, it's ours now, right? Okay. Let's say I'm not extreme communist, I'm not extreme capitalist. Every country is going to do the same thing: protect their natural resources, make sure they're paid the full value for them, uh, uh, or nationalize. So let's go through a couple examples of exactly what you're talking about. For example, this is a fact, right? China, you can no longer go into China as an American company and just take the lithium powder. We don't want that. We'll give you our lithium powder, but it has to be after you build a battery factory here. China wants their economy to be built. So what are they doing? They're going to get more money for their lithium, right? Go to Mexico. Mexican silver mine, not as obvious. Did Mexican nationalize? No, they're not saying they're nationalizing, but they're taking a lot of their own silver and they're negotiating with Newmont. We're on strike. I mean, it's the workers, but it's the country. They're making sure that their people get more money for the gold and silver that come. That's a big deal. Them going on strike, already having an agreement is what I call a soft nationalization. Newmont, you want to pull silver out of the ground here? Pay us more. Pay us more, right? Let's go to Africa. Ghana, right? Ghana started this death of a thousand cuts thing going. Ghana says, you know what? We're tired of pulling our gold out of the ground, calling Goldman Sachs up, selling to them $50 lower because they're front running us, getting our dollars, and then going and buying diesel from Russia. That's what they do, right? So Ghana said, you know what? Our supplier of diesel, we'll say it's Russia, it could be anyone. Our supplier of diesel says they'll accept gold now. So now Ghana pulls the gold out of the ground. They don't hit the bid at Goldman Sachs to get dollars. They go like this here, and they get spot. Maybe they get a moving average of spot. Staying with Ghana. Related, Ghana negotiates with Newmont again. Ghana says to Newmont, you know what? All that gold you pull out and take out of the country, a percentage of that has to stay here. We want you to sell it to us. So it's another soft nationalization. Countries are saying you can't leave the country, pay us more to leave the country, or in China's case, build infrastructure here. Italy, they're like, no, these are critical. What's the word they're using? Critical natural resources: zinc, aluminum. They don't mention silver though, because it sounds lunacy, but silver's too important. If you mention, like for example, I read in the news the other day, J.P. Morgan has been contracted by the U.S. to buy aluminum and zinc as critical resources. And I went, who's contracted to buy silver? No one? Silver's not critical? Of course it's critical. They don't talk about it because they're buying it. You know, they talk about what they can talk about. The whole world is ring fencing its commodities, right? Right. And what's the U.S.'s commodity? Well, we have oil. Our real commodity is our technological innovation. And our so we chips, computer chips will be our commodity, right? Let's pretend that we get this going, and let's pretend that, for example, Taiwan is no longer a factor, however it resolves. But we're going to have computer chips, and we're going to say our productivity is our money, and that's our natural resources, and we don't want China to have chips, right? With that, uh, so they have to build their own, and that's what they're doing. So every country has either hard or soft nationalized, and it's going to get worse. And the area of the world that's really left out in the dust right now is Western Europe. They have problems because they're playing from the ESG woke side, and they don't have the resources. That's why Europe was a power, because they colonized Africa. They colonized these places that have the natural resources. But anyway, you're right. Nationalization is what's happening, which is, by the way, it seems like a communist thing, but it's not. It's actually a mercantile thing. Countries say, you know what, like Argentina, you want beef? Argentina says you have to buy it from us now. It's not free trade anymore. So yeah, that's what's happening.
Yeah, no, it's important. I really do appreciate that. I'm sure the viewers do as well. I mean, regionalization, mercantilism, these things are really starting to pronounce itself more and more. Last question here, Vince. I thank you for the time you've given. Really, what's the future you see, and what are you doing to either create wealth or protect wealth?
To I'm going to pull a page from what someone else has said, because that's what I'm doing. Um, just being very specific here. Um, Over the last 12 months, to give you an idea of this, I'm doing two things. I'm putting a larger percentage into um, gold and silver, not real estate, even though that's probably a smart thing to do depending on where you do it. It's too regional. And I'm looking at stocks in a more next generation way. So I want to buy companies that benefit domestically from. Uh, I want to buy companies in the U.S. that either benefit domestically from the manufacturing revolution, which would be chips, which would be cybersecurity, which would be uh, next generation robotics, things like that. Uh, and I also want to buy companies that are United States based that have exposure to foreign countries. So I'm not telling you to buy Hershey's, but Hershey's is an example. Hershey's, it's a chocolate bar. Americans are, well, they're going to start buying them in China, that type of stuff. So I want to buy American companies that have international exposure for consumer goods, or American companies that are going to be protected by American government to grow. For example, I'll give you a real example. To protect my wealth, it's silver and gold, right? To grow, see, that's a lot of people say, "Oh, I want to grow my wealth with silver and gold." No, no, you don't do that. I mean, you don't do that. If I had put 5% of my net worth into silver and gold 20 years ago, the number is now 15%, and maybe higher, depending on what you look at. Now, that's also dependent on your age, it's dependent on your net worth and what have you, and your ongoing responsibilities. But just circling back, uh, as bonds mature, I'm buying precious metals. That's what I'm doing, right? And on the equity side, I'm trying to figure out how to be right. So the themes to grow wealth are to buy the companies that benefit from reshoring, onshoring, friendshoring, and sadly rearming with the military stuff. And the way to protect the wealth is, instead of having 5%, I want 15%. The person that I'm well read in, or at least at one time was, Zoltan Pozar. I've written a lot about it. I'm pretty good at translating his stuff. Okay, I'm pretty good at reading his tea leaves. And one of the things he said was, the 60-40 portfolio, 60% stocks, 4% bonds, should be 25, 25, 25, 25 now. So 25% stocks, 25% bonds, 25% um, precious metals, and 25% industrial metals. So it's basically 50% commodities, one way or another. And I think what you want to do is, you want to, for your sanity, I think you want to own a part of the old world and a part of the new world. So your portfolio is going to be like a barbell. I want to own the old energy, oil. I want to own the new energy. I don't know, nuclear. Who knows, right? I want to own the old money, gold, which is going to become the new money, right? I want to own the new money, chips. Chips aren't money, but they can exchange like money. I want to own the opposite ends of the pole, because if you get these two ends right for your net worth, right, the stock picking and all that other stuff will be easier, because you will have picked the right industry. I didn't pick IBM, I picked Apple, that type of stuff. But you got to get it right. And
Yeah, I hear you. I picked Dogecoin, so I'm not one to to be to be talking about what to pick here. But I mean, again, just to be clear, none of this is financial advice. This is simply what Vince is doing. So let's be clear on that. But Vince Lanci, before we head out, can you let the viewers know how they can follow you and about the services you provide?
Sure, sure. One of the things I have, it was a hobby that started during COVID, that's become almost a full-time job, and it's actually a work of passion. Many of the concepts we talk about here, as well as tactical, practical concepts focused on precious metals and money and international geopolitical issues, can be found on Goldfix. And Goldfix, it's a Substack newsletter, Goldfix Substack. And I'll have a link for you. For if any of your subscribers want to sign up for the premium version, I'll have a 30% off for life. But if not, sign up for free, and you can get an idea what's going on. That's the way to find me. You can find me on Twitter as well, but I'll have my Twitter handle in the Substack account. Goldfix on Substack. That's the way to find me. Or maybe teaching a class at MBA UConn next semester.
Vince Lanci, it's been a real treat speaking with you. The work you are doing at even Arcadia Economics with Chris Marcus, and of course with Bai Xiao Jun, is some of the best out there. And for Bai, hopefully we'll get him on one day as well. We can do it in Mandarin for him. But the three of you are simply a blessing to us all, and I greatly want to thank you for that.
First of all, thank you so much for having me on here. And yeah, I'm pretty lucky to have met him because we're two people that have similar disciplines in terms of how we approach things, but different knowledge bases. He knows things I have no idea about, and hopefully I add some value to him. But with regards to this show, this has been a tremendous pleasure and an honor. I really appreciate it. Thank you.
All right. Thank you, Vince. Appreciate it also. That was Vince Lanci sharing his views on the bigger picture of silver. And be sure to join us for part 2. If you'd like to follow more of Vince's work, please go to vblgoldfix.substack.com. If you like this video, please do subscribe, share, and give us a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.